Hello, hello. Good to see everyone. I wanted to talk today about buying your first home and how to prepare and be ready for the biggest investment of your life. I know that for many of you, you know that I usually am talking about purchasing investment property. However, your first home is the biggest purchase and the biggest investment of your life to date for many of you. And so I do want to go over some of the things that you need to know about purchasing your first home, some of the benefits to being a first-time home buyer, and of course, answer any questions that you have about buying your first home. So first of all, why home ownership? One of the reasons for that is it's the easiest way to build your wealth. For a lot of people, saving up money and trying to acquire their wealth via being owning a lot of stocks, etc., is just very difficult, and it takes quite a long time and quite a bit of dedication to continue to investing into that. And for some people, a property is literally just a forced savings account. You're actually having to make payments every month, and you are paying not just interest but also principal, and you're paying down your own personal mortgage, which is one of the big things because you're slowly paying down the mortgage and building that equity in the home. Now, on top of that, too, average home prices generally appreciate in most markets, especially major urban markets in Canada. You'll typically find that the home values tend to continue to appreciate. And in Vancouver, as an example, the average home appreciation has been something that close to 6 or 7% on average for the last 30 years. I wouldn't expect and anticipate that you would see that trend continue. That's a pretty high number. But the reality is that banking on an annual appreciation over a long period of time of about 3% per year seems to be a reasonable expectation for determining where home values may be in the future. One of the cool things too is you can also borrow against your home equity. It is much harder to do that with other investment vehicles like stocks, et cetera. And so being able to purchase a home, pay down the mortgage, and then eventually, if you have other debts that are at higher interest costs, borrowing against your home is one of the cheapest places that you can borrow against because it is considered a very safe asset to lend against. So the security from the bank's perspective is very, very solid. And for those of you who want to learn more about this, we do have other videos that I've put together about borrowing against your home, tax deductibility, and all these other things that have some other advantages as well. One other important thing too, you control where you live. And for many of you, I've had a lot of conversations just over the last 6 weeks or 8 weeks here, and the call goes something along the lines of, "Hey, I didn't want to move. I have a really good deal on rent, but I'm getting evicted. My landlord is selling the place. The new buyers are buying it, and now I have to move, and I have to move in the next 60 days against my will." And that's something that is also a major consideration as well, is that if you own your own home, you get to control where you live. You're in full control and in the driver's seat. So there's a few different benefits of being a first-time home buyer. I do want to go over these and give you an indication of what those look like. First of all, the RSP plan. So you can withdraw up to $35,000 out of your RSPs tax-free, and you have 15 years to repay those. And I will get into some more information about the RSP withdrawal in a minute. Also, on your taxes, you can get up to a $1,500 tax credit on next year's tax return. So when you file your personal taxes, you can qualify for up to a $1,500 tax credit. This is something that the government does have to vote into the budget every single year, but they have typically been voting this into the budget on an annual basis. Property transfer tax. This is something that's actually changed very recently. So property transfer tax is a tax that you have to pay on the property value in certain provinces. So in British Columbia, we just actually changed this property tax amount. And it used to be that if you paid under $500,000, you didn't pay any property transfer tax. Between 500 and 525, you paid a percentage of it, and over 525, you used to pay the full amount on it. Now they've really recently changed this so that under 500, you don't pay any tax. 500 to 835, you pay a percentage of the tax, and then over 835, you pay the full tax. So they've changed the scale drastically, which is great because for the longest time, it was very difficult. And a first-time home buyer being able to only buy something under 525 and not paying the full amount of the tax was a very, very large expense for them. And it didn't really make a lot of sense either, considering when I first started in the business, this first-time homebuyer eligibility was about 375 to 400, somewhere in that range, and they've only bumped it up by about 25% over over the 17 years that I've been a mortgage broker, and yet home values have at least doubled over the same time period. So seems a bit crazy that they wouldn't have used a much higher number. And the last one that I wanted to mention here too is there's the FHSA account, which you could put $8,000 per year into, and I'll talk a little bit about what that is. And so there are a couple of different ways that you can save up for your down payment. Of course, there is the new first-time FHSA, it's called, first-time home buyer savings account. There is also just the standard RSP plan. And so as a individual putting money into RSPs, as a first-time home buyer, you can withdraw up to $35,000 out of your RSPs tax-free, and that's per individual buying the property. And any gains that you earn while the money is in an RSP is not taxable. So that's one of the benefits of putting money into an RSP. The money does need to be in the RSP for at least 90 days before you take it out. So that's something that you do need to consider. And then the contribution amount, you can contribute an amount that's based on your annual income. And so every year in your notice of assessment, you'll see a little note that says this is what your contribution limit is. And so that's how you determine how much you can actually put into it. And one cool thing is you can actually combine this with the FHSA. So you can combine using the RSP plan as well as the FHSA plan as well. The FHSA is slightly different. You can withdraw up to $40,000 tax-free. However, the difference is you're only able to contribute $8,000 per year. So it will take some time for you to slowly build this up. And similarly to an RSP, any money that's in this account, any gains that you earn, so if you're earning an income on it, you do not pay tax on those earnings, just like an RSP. If you do not use the money in the FHSA, you can actually convert it to an RSP later on, which is nice. So that means it doesn't mean you have to fully commit to buying a home. You can put money into this and then not use it and instead decide to convert it to an RSP. And you can combine this with the RSP. So there's a couple of different routes that you can take, the RSP plan and the FHSA plan. And both of these are ways that you can save up for your down payment for your first home much faster. And so, yeah, they've got the first-time buyer incentive, which, by the way, this is something that we used to have until very recently, and they've recently canned it. So I don't want to go into details, but just a couple of days ago, their first-time home buyer incentive was canned. And I will say this, not a lot of people were actually using this program, and so it wasn't really a huge loss. Out of the last couple of years that this product has been out, I think I've had only one customer actually utilize this, and the benefit just wasn't really good. There is, of course, some drawbacks with having the government be a partner on your home. Now, a lot of people like to partner with the government to have a piece of their home. So this program, in case you're wondering, that first-time homebuyer incentive has now been canceled as of very recently. Now, one of the things that, of course, you may be thinking of as well, I know there's some incentives, but I'm not sure if I should even own or I should be continuing to rent. We've actually built out a spreadsheet. I love spreadsheets, but I've built out a calculator that allows you to calculate whether you should rent or whether you should own. So you're able to put in what you pay in rent, what the property value would be, what your future net worth would look like, and you're able to map all of this out to determine whether purchasing a home or continuing to rent is the best move for you. And it factors in what your savings rate would be on your down payment you put down, et cetera. So it's a really cool tool. If you did want a copy of that, then feel free to reach out or go to our website. You can download the rent versus own calculator right there. Or, of course, you can email us at info@greenmortgageteam.ca for a copy of that. So if you're still on the fence and you're not sure if owning versus renting makes sense, I will say there are certain circumstances where it does make sense to continue to rent. I'm not going to pretend that owning always makes sense. But you might be surprised that even in your circumstances, you may be surprised that ownership actually makes more sense than renting in your case. So, of course, being a homeowner is not all rosy. There are some things that you need to understand and be prepared. Getting a mortgage is not a lot of fun, and so is probably the least fun part of the process. But there are some things that you need to consider when you're getting prepared to buy your own home. So there's a couple of things I wanted to go over here. The first thing is it's really important to start saving. And that's where you can utilize the FHSA, you can use the RSP plan. One of the things that I like to tell people to do is to start saving up money based off of the difference between what you pay in rent and what the total cost of ownership would be. The reality is, in general, ownership usually costs more than rent. Not always, but often. And the part of the reason for this is that when you own your own home, you're paying down some money towards principal and interest. And so you're paying down your own mortgage. And you factor that part out of it, the amount that you throw away and flush down the toilet in interest and other expenses like taxes, that often is very similar to the rent amount, but you're also paying down your own mortgage. And so one of the things you want to take a look at here is just making sure that if your rent is $2,000 a month and maybe owning a home is $2,500 a month, then you should be getting accustomed to at least being able to save that difference, that $500 a month, so you can get used to being able to save that money and also making sure that you can afford it on a budget. Another important thing is you want to make sure your credit's in good standing. Most banks nowadays have the ability to check your credit online right through the bank, but you can also go to Equifax. If you're getting a mortgage pre-approval with a broker, then they can pull your credit and they'll tell you what your credit score is. So in general, making sure that your credit's in good standing, 700 plus is basically what you're looking for. And then getting connected with a good mortgage broker to get a pre-approval. It's really important to make sure that you get a pre-approval and ensure that you know what you qualify for, making sure that everything is all organized. Don't get caught up in not getting this done and organized, and then all of a sudden saying, "Oh, I'm shopping around and looking at homes," and then find out after you get emotionally attached to something that you actually don't qualify for the mortgage. If you start the mortgage process early and there are challenges with your income or with your credit, the more time that you have, the more you can fix it. If you start and you need to get a mortgage in a month or two, that doesn't give us a lot of time to fix credit or fix income. But you start really early in the process, it's a lot easier for us to say, okay, if you do this, this, and this, then you will qualify in the future. And we've helped a lot of clients set up their finances in a way where they do get to qualify in the future. So a couple of things, mortgage brokers versus quoting your banks. This is, of course, a different process. So one of the questions we get is why use a broker? One of the things that we do is we're shopping over 40 different lenders to find you the best rate and best product. And then the awesome thing about us is that we're actually paid by the lender because the lender has minimal costs. They don't have a lot of overhead costs. The channel is much more efficient. So when a broker sends a deal to a lender, it's typically pre-packaged, pre-screened. The broker's gone over the rate and the product and everything with the client to understand and make sure that that's what they want. And then when we send in a deal, it's a very high likelihood that the bank wins the business. And then they only pay the broker if the mortgage funds. At the branch level, et cetera, there's a lot more overhead. There's a lot more costs. There's all the employee salaries, benefits, the brick and mortar overhead of having the location. In general, these people don't do mortgages all day long. They do a mortgage or two, per month. And so they don't know all of the documents, know all the full process inside and out. And so in general, it's a little bit of a less efficient process from that perspective. As well, when dealing with a broker, there's no bias or no negotiating. The reality is the lenders don't pay us more or less depending on the interest rate that they give to us to give to you. They just say, here's our best rate, take it or leave it. And we're shopping around to figure out which lender has the best interest rate available for you. Mortgage brokers specialize in just doing mortgages. We know these inside and out. We're very adept and very good at knowing how to get a mortgage approved and how to get it done, what documents are needed, et cetera. And mortgage brokers are mobile, flexible, and are with you for life. Most people don't get into the mortgage business, and if they're good, they usually stay around for quite some time. I know myself, my own personal experience when I go to the bank, I get a new person every single time, and I have to restart the relationship, restart the process. Whereas with a mortgage broker, we're always here and available for you, and in general, we're here and with you for life. So let's talk about getting a mortgage. First of all, let's talk about the elephant in the room. It's not the most fun thing ever. We do try to make it as easy as possible. One of the things that the Green Mortgage has set up is our process, and so we're very process oriented. We created something called a roadmap, and so as you reach different milestones of the transaction and the process, we can continue to update you and let you know this is the stage that you're at. You're now at this stage. You're now at this stage, and then that way you always know which stage you're at in the process, and you understand what is next and what is about to happen. So we like to keep you informed. Our system that we've developed and created automatically lets you know what stage you're at so that you know exactly where things are at and make sure that there's clear communication there. So that's really important. Of course, the pre-approval is a really important part of the mortgage process too. Now, the pre-approval does a couple of things, but first of all, it lets you know how much you qualify for. That's a really important part of the pre-approval. As well, it will hold interest rates for 90 to 120 days. So it ensures that that you have a rate hold in case rates go up. And we'll talk about rates in a little bit, but if rates go up, if you have a pre-approval, then you're good. If rates go down, you can still get a lower interest rate between now and the completion date. So the pre-approval doesn't hurt you or harm you in the sense that your rate is now locked in. You still have flexibility. You can still shop around with your broker for that mortgage. The other thing that's really helpful too is it's making sure you're prepared so you can put your best foot forward. One of the things that I'm finding is the market is starting to heat up. And what happens when the market heats up? Timelines start to shrink. Just a month or two ago, a lot of our clients were writing offers and you could get 5 business days, 7 business days on a contract, no problem. Now, all of a sudden, we're finding that the market is tighter. There's more people trying to bid for the home. And those subject removal timeframes, so the timeframe that you write in the contract to say this is how long I have to do my due diligence, that is starting to tighten up. And a lot of people are starting to find that if they don't write a really tight date, then they won't win their bid. And one of the things that you can do is getting a pre-approval and getting your financing all in order ahead of time will ensure that you're able to put your best foot forward and maybe you can put a more attractive offer on it because you can have tighter timelines. So that's really important to look at. So one of the things that comes up a lot is, how lenders qualify you for a mortgage. So there's a few different things that they look at. One of the things that's very important, of course, is credit. So the minimum credit score that generally the lenders are looking for is about 620, but ideally it should be 680 or 700 plus. For the income, generally speaking, the lenders want to ensure that no more than about 44% of your gross income is used towards all of your debts. So if you make $100,000 a year, then you want to make sure that no more than $44,000 of that income is being used towards all of your debts. Now, I'm just realizing that there is one thing that I did not fix on my slides in my presentation because interest rates have gone up over the last couple of years, and this number has changed a little bit, but now it's about $25,000 of income per 100 grand that you're borrowing in order to qualify. So that number is a typo. It should be $25,000 of income per 100 grand that you're borrowing. So if you make $100,000 a year and you have no other debts, you'll probably qualify for about a $400,000 mortgage is the basic math there. A down payment. And so there are a couple of things that I wanted to clear up about down payment. So 5% is the minimum down payment. In addition to that, they have a scale. So 5% of the first 500,000, and then you need to put 10% in the balance. So if you bought something for $600,000, let's say, there'd be 5% on the 500 grand, so 25,000, and then 10% on the extra $100,000 from 500 to 600. So you need to put an extra $10,000 down on that portion. So the total will be 25 plus 10. So $35,000 for down payment. So again, it's 5% on the first 500 and then 10% on the remainder. As long as you're purchasing property under $1 million, then you can do 5% of the first 500 and then 10% of the remainder. But if you're buying a property for over $1 million, then you need 20% down minimum. And keep in mind that when you put less than 20% down, your mortgage needs insurance. And so this is not insurance that benefits you in the sense that if you get sick, that they'll cover the mortgage payment for you. That's something different. Your mortgage would need to be insured by one of the 3 mortgage insurers in Canada. And the insurance is actually for the benefit of the lender. So it covers the lender in the event that you default and they foreclose on you because you don't have a lot of equity in the home. They want to make sure that there's enough strength and security there. And by insuring the mortgage, the insurers are going to be the ones that cover the loss for the lender if there is a loss. And so if you put less than 20% down, the mortgage is insured, and that means that you're getting a 25-year amortization maximum, not 30 years, which you can get if you put 20% down. And an insurance premium is added to your mortgage amount. So they take a percentage and they add it to the mortgage amount, and that's what your payments are based off of. Now on the property should be in good shape. It should be in good condition, marketable. There should be no issues. So some of the issues that sometimes come up, not every lender will lend on leasehold property. Not every lender will lend in certain areas or certain markets. If the property's in really bad shape, it's harder to finance. Another example of this would be a prior grow up. Even though marijuana is now legal in Canada, if it's a previous grow up, then it's very difficult to get financing on it. Not every lender will do it, and some lenders will still consider it, but it is much more difficult to get financing in certain cases. So just keep that in mind. Sometimes we do find that that first-time home buyers are trying to buy properties in a building that is not in great standing. So there might be some upcoming special assessments and other expenses. And honestly, usually if the insurer is not wanting to insure the mortgage, or the lender doesn't want to do the mortgage, there is something for you to consider too, because usually they're just worried about the property risk itself, and maybe you should be too. So that's something to think about, as property is also a factor in this. Now, on the mortgage insurance component, your mortgage insurance is based off of the loan amount. So it's looking at the loan to value, so the percentage of financing that you're getting. So if you're getting 95% financing, that means you're putting 5% down. And then the insurance premium is based off of that. So if you put 5% down, and then the 4% premium gets added, you're basically financing 99% of the home, because that 4% gets added to your mortgage, and therefore you're borrowing 99% of the property value. Now, on the down payment side of things, there are some different down payments that are available. You can do the traditional sources, which is using your own savings, taking money at the RSPs or FHSA. You can take a non-repayable gift from immediate family members. You can take proceeds from the sale of another home. And of course, if you're selling another home, you're not technically a first-time home buyer, but you can still do that. Or funds borrowed from proven assets. You can borrow from other real estate. Now, one of the things that's important here too to consider is that when you're putting your down payment, you do not need to be a first-time home buyer to put 5% down. That's a very common misconception. So you don't need to be a first-time home buyer to put 5% down. If you've previously owned a home and you're buying another residence, you can buy it with as little as 5% down. Now, there are some non-traditional sources of funds that are available too. So borrowed funds are potentially eligible under certain programs. And so some lenders do have a program where you can borrow your down payment. They factor in a really high payment to make sure you can qualify, but they do factor in borrowed down payment. Gift from not an immediate family member. So this would be like an uncle or an aunt or somebody like that. More difficult. Usually the lender wants to see that it's a parents or grandparents, so somebody above you in the family tree, not somebody that's beside you or on an angle. So just keep that in mind. Something that is used to be considered, and nowadays I don't think I've ever seen a deal get approved for this, but sweat equity is something where you've put value into a property and that's being used for your down payment. So I haven't actually seen this ever be a thing, and I don't think that lenders even approve it anymore. And then cash back, we used to be able to use cash back towards down payments. The bank would actually give you some cash back on your purchase, and you could use that towards your down payment. Nowadays, the lenders don't, or the government doesn't allow that. However, there are still lenders that will give you cashback mortgages. They charge a little bit of a higher rate, but they give you some cash back, and you can use the cash back to pay off debts or do other things with, but you just can't use it for down payment. So talking about the total amount of money that you're going to need, you're going to need a minimum 5% down, and then there's some other costs involved too. So in British Columbia, the property transfer tax is 1% of the first 200,000, and then 2% of the balance. And again, this is if you're buying outside of the range that we talked about. If you're buying between 500 and 835, you'll pay a percentage of the applicable tax. And so if you're just a little bit of the way through, if you're buying at 520, then you're going to pay a very small amount. If you're buying at 830, then you're going to be paying almost the entire property transfer tax amount. So there are good calculators online. If you can't find one, just let me know and I can point you in the right direction. But there are good calculators that will determine the property transfer tax amount for you. Legal fees, generally speaking, when you purchase a home now, I would say this is probably, inflation has bumped this up. It's probably close to about $1,500 now per transaction for the legal fees. So that's seeing a notary or lawyer to register the mortgage on title. And then there's usually some adjustments as well. So there's little tiny expenses that get calculated at closing. One thing to consider, property taxes are due on July 1st of the year, and that's for the entire year. So it goes kind of backwards and forwards. Now, one of the things to consider here is that if you purchased a home in May, let's say, then the seller owes you some money because you're going to pay the property taxes in July, but they live there up until May. So they owe you some money. If you purchase the property after July 1st, then you owe the seller money because they paid it on July 1st, but you're getting the benefit of living there for later in the year. So this is where some adjustments can go back and forth, either in your favor or in the other direction. I do want to talk about the process of writing an offer. And so In general, what's happening here is there's usually you preparing to write your offer. It usually takes a day or two before the offer is accepted. There's some negotiating, going back and forth, and whatnot. And this is where you're working with your realtor to get an offer accepted. As soon as it gets accepted, that's when you want to make sure that you're reaching out to your broker and saying, hey, I've got an offer accepted. I want to make sure they get my financing and get all my options detailed for me so I can figure out which route to take. You also want to make sure that you get all the due diligence information. So that's when you want to review the strata documents ASAP and make sure that you review those. Make sure you arrange your inspection, and this should happening as soon as possible, or at least perhaps after your financing approval, but before you have to remove the subjects. Removing subjects means that all of these due diligence conditions or subjects you wrote in your offer, you're going to then remove those conditions. Usually it's about 5, sometimes up to 10 business days after writing the offer. And this is where you're saying, my financing is good, my inspection is good, I reviewed the strata documents, they're sufficient, etc. And you're removing your conditions. And now you're what's called subject free. So now your offer is you're 100% buying the property. And that's when you provide the deposit check. So once you've removed all the subjects, you provide the deposit. The deposit is usually 3 to 5% of the purchase price. And this deposit is a credit towards all of your closing costs at closing. So a lot of the time, the deposit ends up being about the amount of the down payment. It doesn't have to be, though. It's not the same as the down payment. It just often ends up being a similar number to the down payment. So if you provide a $10,000 deposit, but your down payment's $20,000, then that just means you still have to bring in an extra $10,000 at closing to close out the transaction. Now, on the due diligence side of things, there's a lot of things that you want to review. You do want to check the strata documents. So those would be the AGM meetings, 2 years of strata minutes, what's called the strata form B, the most recent strata budget. You'll want to see what the property disclosure statement is, and that's something that's filled out by the seller to give you a better understanding of the condition of the property, whether they know of any detrimental aspects to the home. So that's something that's filled out, and that's a BC document. So these are things that you're looking for in the strata. You also want to see if there's any deficiency reports or anything like that done by the strata too. And on a detached home, there's a few things that may or may not be applicable, but a survey, if it's applicable. So a survey just maps out and says, yes, your home is inside of the lot line. If you're buying a fairly old home, then homes back in like the 50s and 60s and even 70s, they may have had an oil tank on the property. Oil tanks need to be removed in order for lenders to lend on it because there could be environmental hazards with oil leaking into the soil. So if it's an older home, you may need to be getting confirmation that the oil tank has been removed. Most of them have been. It's very, very, very rare now that we see that a home just still has an oil tank on it. Receipts and warranties for any major repairs like a roof or furnace, and then ensuring that there are permits for various work that was done. So closing now. So now you've written your offer, and now you're getting to closing, and there's a few things you need to consider. So it's called the solicitor. That's the notary or lawyer, and this is the person that's going to handle the legal side of the transaction. They're the ones that take in the money from the lender, take in the money from you. They balance all the money, and then they distribute it out to the lender and out to use the borrower. And so they're the ones that are dealing with this. And you're usually meeting with them about the week prior to closing. And you want to make sure you choose a notary or lawyer at least 3 weeks before closing, often earlier. Your realtor or mortgage broker typically will know one if you don't know anybody. Really important that you get insurance figured out as well. So you need to have home insurance. This is a huge liability, especially in a detached home. If you have a condo that you're buying into, part of your strata fees will cover insurance for the shell of the unit, but that does not include fridges, stoves, all of your furniture, and all of your interior. And so this is something that's important to make sure that you have your own contents insurance as well. Moving. One of the big things that you want to make sure of is if you're moving July 1st, August 1st, the very end of the month, etc., movers get really, really booked up. And so it's really important that you think about getting a mover as soon as possible. So as soon as you remove the subjects, you should start to organize a moving company. And then closing is when the money changes hands, and you'll be meeting with the notary or lawyer to sign documents. And then you're getting the keys on what's called the possession date. That's usually the day after closing. So I want to talk about a couple of tips before I wrap things up here. First of all, the RSP money out of nowhere trick. So if you are purchasing a home and you're thinking they're going to be buying a home fairly soon, if you put money into RSPs and let it sit there for 90 days and then take it right back out again, and you can do this with the HSA as well, when you buy your first home, you're effectively getting money back on your tax return because you get a rebate on your taxes when you put money into RSPs or HSA. So if you're looking at saving up for your down payment, if you were to make a lump sum and pay into your RSP and put in, let's say, 10 grand into RSPs right before the deadline, so now on your tax return, if you're at a 30% tax bracket, you might get $3,000 back on your tax return. So now you have 10 grand in the RSPs and then you have 3 grand that the government gave you back. So now you have technically 13 grand. So you turn 10 into 13,000. So this is the RSP, money out of nowhere trick, and it works really well, especially the time has passed now to do this particular trick because the deadline has passed. But if you do this before the RSP deadline at the end of February, then this is a way that you can generate some money out of thin air. I'm going to say this: vehicle loans are a killer. So if you have a $500 a month vehicle loan payment, it will lower your borrowing power by about $100,000. So this is a really big, important thing to consider and think about. If you're thinking about buying a home and buying a vehicle, buy the home first. I'm telling you right now, it is so much easier to qualify for a vehicle than it is to qualify for a mortgage. So buy the property first and then get the vehicle after. The number of times that I see, young people making good money and they've got a really expensive truck loan and that's what's holding them back from being able to qualify. And then they realize that it's either a home or the vehicle, but they've already purchased the vehicle. It's really upsetting. So just keep that in mind. It's easier to get a vehicle loan than it is to get a mortgage. So you get the mortgage first and then get the vehicle loan after. Also, unsecured debts are also a killer. So if you have about $20,000 in unsecured debts on credit cards, lines of credit, anything like that, that will also lower your borrowing power on a mortgage by about $100,000. So you got to keep that in mind too. So of course, everybody always wants to understand what's going on with interest rates. So before I wrap things up, I will talk a little bit about the current trend in interest rates. So as of right now, there's always a lot of movement with regards to where interest rates are likely to head. They seem to be stabilizing a little bit right now, and we're projecting flat to decreasing interest rates during the year of 2024. Currently, people are expecting the Bank of Canada to be down about 0.75 to maybe 1% down by the end of the year. So anybody taking a variable rate would see that their interest costs would decrease throughout the year. And in 2025, people are projecting another 0.75 to 1% decrease. So about 1.5% to 2% lower over the next 24 months. And that would affect anybody that's in a variable rate. Now, the Bank of Canada, it's really important to understand, does not set the fixed rates. They have an impact on it to a certain extent, but they are not the primary or only driver in that. So fixed rates are correlated with bond yields in the bond market. And what we've seen so far is that the bonds move up and down based on the projections and where they think the Bank of Canada is going to go and what's happening in the economy, et cetera. And as of right now, bonds are a bit lower than the Bank of Canada. And so it looks like fixed rates are lower. And at this moment, anyways, a fixed rate is generating a lower interest rate than a variable rate is at the moment. And so currently there's some slight downward pressure to flat pressure in the fixed rate market. What we're finding right now is that if you're taking a 5-year fixed rate and you're putting less than 20% down, so you're getting an insured mortgage, you're able to get a rate below 5% if you're purchasing a property or if you're coming up for renewal and you have an insured mortgage. So an insured mortgage is usually the best pricing. So again, putting less than 20% down, you should be able to get a 5-year rate below 5%. There are other terms available, of course, as well. The 3-year fixed rate has been very popular, and those are in about the low threes right now. And the shorter the term, the higher the interest rate. And that's because the markets are expecting rates to go down in the future. So short-term money is more expensive because right now rates are high, but they're projected to go lower in the future. And so you'll find that a 1-year rate will be quite high, and then a 2-year rate will be lower, a 3-year rate will be lower, and then a 4-year and a 5-year a little bit lower still. So just keep that in mind when you're looking at where mortgage rates are heading. And we probably follow the bond market and check it almost daily in order to see where things are at and give you some feedback on that. And so when I do wrap up, we're just finishing up now. I'll make sure that I answer any questions people have about mortgage rates because that's a really common thing. So if you wanted to learn more, feel free to book a consult with us. You can go to our website and you can reach out to us that way. You can also email us at info@greenmortgageteam.ca. And of course, on our website, we have lots of upcoming webinars. We have a first-time home buyer guide. We have our downloadable spreadsheets like the rent versus own calculator. And for those of you that are wanting to learn more about investing in real estate, and maybe you're thinking that this first home is going to be a residence, but you still want to be investing in real estate long term, I do have a book called Rockstar Real Estate Investing that talks all about how to invest in real estate, how to start from step number one, and teaches you the fundamentals. So if you did want to learn more about investing in real estate, then please reach out, and I'm happy to put a copy of our book in the mail and send it over to you too. Awesome. What I'll do now is I'll open it up for some questions, and anybody that has any questions, feel free to use the Q&A or put your question in the chat as well, and we can answer anything that anybody wants to learn a little bit more about. You guys are taking it easy on me. No questions. Okay, well, if there's no questions, which I'm surprised by, if there's no questions, then I'll wrap up the set. Oh, I do have a question. Here we go. So question is, if I have a subprime loan, is it more beneficial not to pay it off before obtaining a mortgage? Really depends on the circumstances. So what we find is that if you're going to qualify for a mortgage, we can often just when we're approving the deal, we can say, if you paid this debt off, then this is what you qualify for. If you don't pay it off, then this is what you qualify for. Sometimes it's better to have more cash for different varying reasons. Sometimes it's better to have less debt. And so I usually say that it's good to go through the pre-approval process and just ask, should I pay off this debt or not? Am I going to qualify for more or not if I pay that off? Frankly, as long as you're making your payments, then it shouldn't have a huge negative impact, but you need to figure out and look at what's the payment associated with it, how much do you owe on it. Sometimes you have a really low balance outstanding and a really high payment. Well, usually it makes sense to pay that off because then you'll qualify for more on the mortgage. I have another question here. So does Airbnb income count as income? Not really, no. So this is an interesting one, and this is a very common thing that comes up. So if you already own a property that is generating Airbnb income or short-term rental income, and you have that property on your tax returns, and you're filing on your tax returns an income amount that is short-term rental, then some lenders will use that number. But if you're purchasing a new property and you're saying that I'm going to rent out my basement suite and I'm going to short-term it, lenders typically do not like to use a projected short-term rental income in the future because it's really hard to know exactly how much money you will make on that. Usually in those cases, we can use what's called the market rent. So market rents is the amount of rental income that you would get if you were to rent it out to a long-term tenant, so an unfurnished rental property for a one-year lease. And so the appraiser could comment on what that amount would be, and then lenders can often use that when they determine your borrowing power. So Airbnb income on existing properties can be possible if it's being filed in your tax return. If it's a new purchase, then the answer is no. Any other questions? Okay, well, it looks like I've answered everything. If anybody has any other questions, then feel free to reach out. Oh, there's one question here. I recently heard about a government program that pays your down payment up to $170,000. You will in the future pay back to the government plus 20%. I'm not sure, 170,000, that's a pretty large number. So I'm not sure what that program would be, but if you have more information or details, then you can send it over to me. But $170,000 is a really large amount. I don't think there's any government program that I'm aware of that would pay, put in that much money. That's a pretty large amount. There are some programs on commercial lending, so that might be a bit of a different scenario, but not in residential. Awesome. Oh, here is another question from Annie. So can we use line of credit for down payment? Yes, you can. So you can use a line of credit for a source of down payment. We have to factor in a payment on it, but you can use a line of credit for down payment. If it's an unsecured line of credit, the payments are much higher, and we have to qualify you with a lender that has the borrowed down payment insured program. The mortgage insurance premiums are a little bit higher, and you have to have a really high income. So it really makes sense if you have a very, very high income and you're not maxing out your borrowing power, then you may be able to qualify to borrow your down payment on a line of credit. Surprisingly, you can even borrow it from a credit card under that program, which I always thought was a bit odd. Any other questions? All right, guys, I'll wrap it up. Thanks so much for coming. If any other questions come up, you can email us at info@greenmortgageteam.ca. Happy to help, and thanks so much for coming out to the event. Look forward to seeing you again. Thanks, everyone.